Hello everyone, and welcome. So today we're going to venture beyond the familiar world of ledgers. You know, the debits and credits. We're going to dive deep into the very heart of corporate ownership and strategy by decoding the language of corporate capital. And look, mastering this language isn't just about passing an exam. It is absolutely essential for making the sound business decisions that are going to define your careers. So here's our game plan for today. We'll start with the legal bedrock of how shares are even created. Then, we're going to spend some real time unraveling the mysteries of share value, a concept that, trust me, trips up so many people. After that, we'll explore the strategic power of stock buybacks before we put all this knowledge to the test in a high-stakes boardroom scenario. And finally, we'll wrap up with a crucial look at the common pitfalls you need to avoid in your own analysis.
Before we get into all the nitty-gritty, let's just pause and think about this for a second. A share of stock, it's so much more than just a flashing number on a computer screen. It's a real, tangible, legal claim. It's a piece of ownership in a corporation, and it gives you a right to its future earnings and its assets if it ever liquidates. And its story, well, it doesn't start on the trading floor. It starts in a foundational legal document, the corporate charter.
All right, let's get right into it. Every single corporation starts with a blueprint. Before a single dollar is raised or one share is sold, the founders, with their lawyers, have to define the entire universe of potential ownership in this corporate charter. This document gets filed with the state, and it sets a legal ceiling, a maximum on the amount of ownership the company can ever create.
I want you to imagine a brand new sports stadium. The authorized shares, over on the left, that's every single seat in that stadium, the total capacity defined by the architect. It is the absolute maximum number of tickets that could ever possibly be sold. Now, issued shares, on the right, well, those are the tickets that have actually been sold for tonight's game. So why is this distinction so important for you as a future decision maker? Because that gap, the difference between authorized and issued shares, that represents strategic flexibility. It's a reserve of potential capital the company can tap into for future acquisitions, for employee stock option plans, or to raise money for a new project, all without having to go through the expensive legal hassle of changing its charter.
Okay, so now that we get the basics of how shares are created, let's tackle a concept that, I'm telling you, often trips up students and even new investors: the value of a share. You're going to see two very different numbers when you look at a company's financial statements, and they each tell a completely different and, frankly, unequal story.
Okay, here is the key takeaway, and I really want you to lock this in. Par value, what you see there on the left, is essentially an accounting and legal fossil. It's usually a tiny fraction of a penny and has almost no connection to the real-world market price you see on the news. The market price on the right, that's a living, breathing, dynamic valuation of the company. It's shaped every single second by millions of investors who are all assessing its performance, its leadership, its future potential, and the whole economic climate.
And that's a great question. I mean, it's a totally logical question, right? If par value is irrelevant to investors today, why does it even exist? Why do we still have to account for it? Well, the answer isn't in modern finance, it's in legal history. And to really get the balance sheet nuance, you have to understand that accounting is full of these fascinating little quirks, remnants of the past that still influence how we report things today. This right here is a perfect example of how accounting rules carry historical baggage. A century ago, way before the SEC and all our modern regulations, par value was basically a promise to creditors. It created a legal capital floor, a minimum amount of capital that had to be kept inside the company. It couldn't be paid out as dividends, so it acted like a safety net for lenders. It was also designed to prevent this really deceptive practice called watered stock. Just imagine a promoter starting a company claiming to have sold a share with a $100 par value, but in reality, they only got a piece of property worth, say, $20 for it. They were watering down the value, tricking creditors about the company's real capital base. Today, with much more advanced protections like detailed financial reporting and debt covenants, par value is really just a historical footnote. So, what happens when a company's journey kind of comes full circle? After issuing stock to the public to raise cash and grow, it later decides to go into the open market and buy back those very same shares. And when they do that, it creates something on the books that we call treasury stock. Now, when a company buys back its own stock, those shares aren't retired or canceled. They're held in the treasury. Think of it like a holding pen. They still exist on the books, but they aren't outstanding in the hands of the public. That means they have no voting rights and they don't receive dividends. But listen, and this is important, this is not just a simple accounting entry. It is a powerful, strategic move that sends a very clear and intentional message to the market. As a future business leader, it is so crucial that you learn to read these signals. A buyback is a kind of corporate body language. When management buys back stock, they're signaling confidence. They're basically saying, hey, we believe the best investment we can make right now with the highest potential return is in ourselves. It also has a direct mathematical impact. By reducing the denominator, that's the number of outstanding shares, it automatically boosts earnings per share, or EPS, which is a key metric for analysts. Now, this is also where some controversy comes in. Some critics argue that companies sometimes use buybacks to artificially pump up their EPS, which can trigger executive bonuses instead of investing that cash in long-term R&D or maybe higher wages for employees. It's a really critical debate you're going to encounter out there in the business world.
All right, I'm putting you in the boardroom. We are moving from the textbook to the real world to analyze a multi-million-dollar decision. You are now a director at a fictional company we'll call Innovate Inc., and you have a critical choice to make.
So, picture this. Your company, Innovate Inc., has been crushing it, and now you have a significant cash surplus of $50 million. Now, that's a good problem to have, right? But it's still a problem that needs a solution. Cash just sitting on the sidelines isn't earning a good return for your shareholders. So, the CFO has come to the board with two main options for this $50 million. Let's break them down together.
What's so fascinating about this slide is the strategic dilemma it lays out. Let's look at the table. Option 1, building a new factory. That's a classic growth investment. It's a bet on the future. The impact on EPS is neutral right now, but the potential payoff down the road could be massive. Option 2, the share buyback. Well, that offers a more immediate reward. Okay, let's put some numbers to this. Let's say Innovate Inc. has earnings of $100 million and 100 million shares outstanding. That's an EPS of exactly $1 per share. Simple enough. Now, if they use that $50 million to buy back 10 million shares, their new share count is only 90 million. Suddenly, with the exact same $100 million in earnings, their EPS jumps to about 1.11. As you can see in the table, that's an immediate increase. Look, there is no single right answer here. A young, high-growth company would probably choose the factory. A more mature, stable company might go for the buyback. The decision hinges entirely on the company's overall strategy and where it is in its life cycle.
Okay, before we wrap up, I really want to go over the most common mistakes that students make when they're analyzing these topics. Think of this as a pre-flight check before you go and try to analyze a company's capital structure on your own, whether it's for a case study or for your future career. Avoiding these fundamental mistakes is going to dramatically improve the quality of your analysis. First, never, ever, ever confuse par value with real value. They are completely unrelated. Second, remember that authorized shares are just potential. Your analysis needs to focus on issued and, more importantly, outstanding shares. Third, you have to always ask why a company is buying back its stock. What's the strategic message they are trying to send? And finally, just like we saw with Innovate Inc., a buyback can sometimes signal a lack of internal growth opportunities. If management can't find a project that earns a better return than just buying its own stock, that might not be a great long-term sign. You always have to ask if that cash could have been used more effectively to build real, lasting value.
So if you take just one thing away from our discussion today, let it be this. These concepts, authorized shares, par value, treasury stock, they are not just abstract accounting rules you need to memorize for an exam. They are the language of corporate strategy and communication. They are the tools that management uses to execute their vision and to speak to the market. You have to learn to think like a strategist and use accounting information as a powerful, powerful decision-making tool. This is a skill that will serve you for your entire professional life.
And that brings us to the central question you're going to face throughout your entire careers, a question that's perfectly illustrated by our Innovate Inc. case study. How do you balance the market's demands for immediate results with the long-term investments that are needed for sustainable growth? We'll dive deeper into that exact tension in our next session. Class dismissed.